The short and easy answer that I typically give when someone asks me, well, why do you want to buy with owner finance and why not use a bank, is because we get better leverage. So if you're an investor and you're looking to buy multiple properties, you're talking about the volume that we do. You're not just buying one rental property or two or three, you're buying dozens. Eventually, and a lot of times the number is 11, when you get to a certain rate with bank financing on rental properties, your terms skyrocket. Your down payment goes up into that 25, 30, or 35% down range. And your interest rate will usually still be pretty decent. But by having to put such a massive down payment, it'll throw off your cash flow numbers. So the more leverage you can get, as a general rule of thumb, the better your cash on cash return is going to be. For those of you that don't know what a cash on cash return is, I'll give a quick, super brief example of how to calculate that. So let's say we're buying a property for round numbers that's $1 million. And let's say that property's NOI, net operating income. So the income that property generates as a rental after paying all of the expenses, loan payment, HOAs, taxes, insurance. Let's say that number is $100,000. So your $1 million property is generating $100,000 in net income every year. So if we go and buy that property cash, we're earning 10% on our money because we take our $1 million cash investment, divide that by the $100,000 in income that investment generates, and that's 10%. So that's our cash on cash return. If we buy that same property with 20% down, let's look at the numbers on that. So now, instead of our cash investment being $1 million, it's now $200,000 cash. The property is still generating the same amount of income because nothing has changed. The only thing that's changed is the way we purchased the property. So let's say on the $800,000 loan that we have, let's say we got a 5% interest rate with interest-only amortization. That means our annual loan payments, our debt service, is going to be about $40,000 a year on that property. So now we take our $100,000 net operating income and we have to deduct our loan payments from that. So now instead of making a net of $100,000, we're now making $60,000 on that property. But now, since we invested $200,000 to get $60,000 instead of investing $1 million to get $100,000, divide that $60,000 by the $200,000 investment, you can see we've tripled our cash on cash return. So instead of earning 10%, now we're earning 30%. So that's a real round number example of using leverage to create a higher cash on cash return. And if you had $1 million, or you can do the same thing if you had $100,000 and the numbers are the same, instead of buying one property cash and generating 10%, you can use that 5 times. Now you've got 5 properties that are now earning you 30%. So over the course of the long haul, your $1 million is earning you $300,000 a year instead of $100,000 a year. So that's the first thing. The leverage is better. Typically, the terms are better. The purchase price is what we care about the least when we buy with owner financing. We almost always pay either at list price or even slightly above list price to get favorable leverage, favorable interest rates. When you do that, it's not uncommon for us to get a 3.5%, 4%, always usually 5%. The highest I've ever paid is 6%. And so with those interest rates, a lot of times that can be better as well. The other thing is, since we're not using bank financing, we're dealing with a human being instead of a bank, which I could talk for an hour and a half about the benefits of dealing with a person instead of Wells Fargo or Bank of America, because you've got an actual human being you can build a relationship with. Over time, as the market adjusts, it gives more flexibility. Let's say the market crashes, for example, and the balloon payment comes up on these loans. If we're dealing with a bank, you're out of luck. Good luck getting anyone on the phone that you can even really negotiate with that even has that authority. You're going to spend hours in customer service lines to talk to someone that doesn't know you, doesn't know your relationship with the property. They're looking at a spreadsheet. You're dealing with a human being. You've built a track record. You've made timely payments for years. They know you. They know your story. And they also know what's happening in the market. So we've had it before where the market crashed. And okay, let's negotiate an extension. And it's easy to do. It doesn't take months of paperwork and bank statements and nonsense. It's a phone call. It's an email. That's one thing. Let's say the market booms. This is something too, since you're dealing with a person, and we had this happen on a property in Pollock Pines, California. It's right by Tahoe. We still owed $150,000 on the owner finance note. We went to sell the property because the market had appreciated so quickly. And I said to the lien holder, I said, hey, if we paid you off 1.5 years early, would you take $100,000 instead of $150,000? I thought that'd be a negotiation point. They just said, okay, so we got an extra $50,000 in reduction on the back end. That's obviously something that you could never even begin to dream of doing with a bank. But at least you have that opportunity to negotiate, because it's a human being that might need the cash, and it might be advantageous for them to get it all now at that point. You never know. The other thing is, if you're using bank financing, over time, I had one client and partner, he had 11 properties with bank financing. It messed up his debt to income ratio. So all of those properties are on his personal credit. So when it came time to refinance his home, his personal residence where he actually lived, he couldn't do it because his debt to income ratio was so screwed up. With owner financing, while you typically will do a credit check to make sure that the credit's good, it doesn't show up anywhere on your personal credit. So you have the income coming in, but you don't have the debt. So it actually improves your debt to income ratio. That's a huge, huge benefit of not tying up your personal credit so much for investment. It gives you the flexibility to live your life, enjoy the benefits of the cash flow you're now generating without the downside of it. So those are a few of the key reasons. I mean, I could literally do an hour and a half, 2 hours talking about all the benefits we've seen beyond that. At the end of the day, there's a lot of benefit to just being able to build the relationship with a person. And quite frankly, most of the people that will sell with owner financing, it's a benefit for them as well, because instead of taking that cash right now, putting it in their bank where they're going to earn 0.2% interest, or put it in a CD where you might get 1.5% if you lock up your money for 5 years. Now they get cash up front, and they get a premium on the purchase price, and they're earning 4, 5, 6% interest on their money. And it's secured by an asset that they're intimately familiar with because it was their property that they chose to sell. So it's good for them as well. And usually these people that will sell these properties will have more than one. That's another reason why I love buying owner financing, dealing with a person, building that relationship, showing them how stable we are with making our payments on time, so that we can hopefully buy other properties from them with the same structure as well. So that's my little snippet for anyone that asks why we buy with owner financing. Again, they are hard to find. If it was easy, everybody would do it. But we have tried and true since 2009. This is the best strategy and formula that makes sense to make our numbers work. And I'm thankful to anyone that took the time to watch this brief video, and I hope that it